Welcome to DIY Finance Guy. I'm Sergey Modilevsky, and in this video, we're going to analyze how this week's volatile financial events are going to impact your mortgage payment, the housing market, and your stock portfolio. Let's get into it. On July 20th, Statistics Canada reported an 8.1% inflation print for the month of June. It coincided with the US CPI report from last week, which had written a 9.1% inflation print for June. Both reports reinforced the urgency of fighting inflation aggressively. The most significant gains by weight of consumer price index were in gasoline, transportation, food at home, shelter, and rent costs. Some folks will flip their lid at the highest inflation reading since 1983. But there's more to consider. Analysts had anticipated CPI in Canada of 8.4%, so the report actually came in below forecast. That same day, they also released the Producer Price Index for the month of June, which came in at minus 1.1%, well below the forecast of 1.8%. It was the first slowdown in producer prices since August of last year, mainly reflecting lower prices of softwood lumber, which had extended a 3-month drop. They're now minus 33% over that period, amid slowing demand for construction. These reports arrived after last week's announcement from the Bank of Canada that they'd be raising the overnight lending rate by a full 1%, which had actually come in above analyst expectations of 0.75%. Considering the Bank of Canada is not meeting again until September, they obviously had the agenda to get ahead of June, July, and August inevitably high inflation readings. Bond markets are now pricing in another hike at that September Bank of Canada meeting, likely at least 50 to 75 basis points. Later in this video, we're going to discuss the economic impacts of that decision, and believe me, there's a lot of them. Leave a comment down below and let me know, how much higher will the Bank of Canada raise interest rates in 2022? Also, please hit the like and subscribe to keep getting this real estate and investing content. We started last week with an update on US crude oil inventories. Since Tuesday, future oil contracts have seen choppy trading after the US reported a small spike in crude oil stocks for the second consecutive week. US President Joe Biden has also been traveling around the Middle East last week, courting Saudi Arabia's government to go ahead and open the oil spigot. We ended the week with US retail sales, which had come in 66% above forecast. It's pretty clear we've got a consumer who's out there still spending aggressively. A lack of supply for goods has caused inflation spikes. That has investors closely watching business inventories for signs that supply is beginning to build as demand for product cools. For June, US business inventories came in incrementally above forecast at 1.4% monthly or 16.8% annualized growth. These manufacturer and trade inventories are growing well above the 25-year trend line. Over the next few months, we're going to see how inventories build as consumers absorb much higher borrowing costs. Here's some of the takeaways from this week's financial reports. Higher inflation rates have led to aggressive interest rate hikes from central banks all around the world, but in particular in Canada and the United States. Homeowners are now beginning to feel that pinch. We've had 4 interest rate hikes this year, starting back in March with 25 basis points, with the most recent hike of 1% in July. That has now brought the overnight lending rate to 2.5%. Let's discuss how these changes affect each type of mortgage product. Variable rate mortgage holders will continue to have increased amortization with every Bank of Canada rate hike. What that means is that you're going to be paying less towards principal and more towards interest. I suggest increasing your payments now to reduce the payment shock at your mortgage renewal. If you hold an adjustable rate mortgage, you've seen your payments increase with every Bank of Canada rate hike. That's likely to continue in September. Now let's look at what that means in dollars and cents. The rule of thumb is that costs increase roughly $24 for every 0.5% of increase on every $100,000 of mortgage debt. If you're on a fixed rate mortgage, don't get complacent. Take this opportunity to increase your monthly housing payment. Or you can set up a pre-authorized contribution from your checking account to a savings or investment account. You may face a much more considerable cost when your mortgage comes up for maturity, and you want to be prepared for that. The Bank of Montreal and Scotiabank forecast that the Bank of Canada will bring their overnight lending rate to 3.5% by the end of this year. That would be 1% higher than the current overnight lending rate. Over the last 4 months, Canadians have learned about the correlation between interest rates and real estate prices. Last month, we had the most significant seasonally adjusted monthly decline in Canadian home prices, greater than the great financial crisis of 2008 and the home downturn of 2017 when the government originally introduced the mortgage stress test. Prices are now down for 4 consecutive months, and many homes are down 20 to 30% from peak prices back in February. The Bank of Canada is ignoring this downturn, forcefully sticking to its sole mandate of fighting inflation. Last week, they raised overnight lending rate another 100 basis points. By increasing the overnight rate by 100 points, they actually raised the baseline qualification rate for anybody that's looking for a mortgage. Overnight, borrowers now have 10% less borrowing capacity when applying for a mortgage. Since the start of interest rate hikes back in March, borrowers now have 25% less borrowing capacity when they apply for a mortgage towards purchasing a home. In addition, Canadians are currently dealing with the highest percent of ownership costs as a percentage of median household income. What that means is that today's housing market has been the least affordable housing market since 1983. Royal Bank economists believe that property values, which are already slipping, are likely to fall more than 10% in the coming year. Rising interest rates significantly affect monthly payments in the country's most expensive housing markets, so it seems likely that Ontario and British Columbia will continue to see a lot of price pressure in the short term. As BMO senior economist Robert Kavchich says, the Bank of Canada has taken a hammer to the housing market. When interest rates rise, consumer sentiment towards housing changes because other fixed income investments become more appealing. Here's an example of what that looks like. You can now lock into a 3-year guaranteed investment certificate that pays a guaranteed rate of return of 4.7% a year. That was inconceivable 6 months ago, but today it offers an attractive alternative investment class for anyone sitting on a decent chunk of cash. With many more options for producing passive income, homebuyer FOMO is the thing of the past. Interest rate changes have affected housing dramatically, but they've also destroyed year-to-date stock market returns. The Bank of Canada's decision to increase overnight rates by 1% was actually welcome news for investors because it signals that the Bank of Canada is serious about reducing inflation and doing so quickly, which brings up hope that we might see lower interest rates in the years to come. Higher prices and interest rates will likely to continue in the months ahead as Russia uses its natural gas supply to Europe as leverage against Western allies. Energy, commodity prices, and a tight labor market drive consumer inflation, and there's no immediate remedy in sight. Additional macroeconomic headwinds over the next 6 months include, but are not limited to, rolling COVID lockdowns in China, the systemic financial risk from mortgage defaults in China, the expansion of Russia's war in Ukraine, commodity drought from escalating temperatures around the world, and the black swan event, however unlikely it may seem, that China could potentially invade Taiwan. Considering the short-term forecast, I have the following advice. Complete a family budget. Do this immediately. It's becoming increasingly important to start cutting personal and business spending. Every dollar saved will increase your odds of managing through this experience without having to sell any of your real estate or your investments. If you have a variable rate mortgage, increase your payments by 10% to reduce your amortization. Taking this step will reduce your payment shock when that mortgage comes up for maturity down the road. Despite what I've discussed, many of you will still be interested in purchasing a home because you may need to upsize, downsize, or you may just want to stop renting. If you're going to get pre-approved for a mortgage or discuss a refinance, you can book a time with my team and me by using the calendar link in the description below. If you're still watching this video, you must like this content. Please hit the like, subscribe, and hit the notifications bell so you never miss these videos in the future. Thanks for tuning in, and I'll see you in the next one.